Hi, this is P.R. Sundar. Welcome to this special episode where I'm going to talk about, what comes to many people's mind. Now, the markets are trading at all-time high. Now, naturally, the question comes to people's mind, is it times to buy or it is time to sell? Number one, if you want to buy, 100% sure this is not the right time to buy. Why? No, I'm not worried because the markets are at all-time high. Markets will always be hitting some kind of all-time high, always. If you can remember, Nifty hit all-time high of 1200 in 2003. It doesn't mean that the market will fall. Market might have fallen, like 5-10% it would have fallen, but then after that, from 1200 it has gone to 22,500. So as the time goes, markets will always keep moving higher, but in the short term we cannot say anything. So in the short term, we need to check if there is any risk in investment. Yes, there is a very big risk, that is parliament election. Nobody knows what will be the outcome of parliament election. And many people try to predict. You go to social media, the BJP supporters will say, no, BJP will surely win. And Congress supporters will say, no, Congress will surely win. But the fact is that, even Narendra Modi and Rahul Gandhi, they do not know the outcome of the parliament election. Who told you that Trump will be winning 2016 parliament election? Nobody. Who told you the Brexit will happen in 2017? Nobody told you. Even people who are doing, exit poll, opinion poll can also go wrong. Many times even exit polls, opinion polls have gone wrong. But what all we can say, there are two possibilities after the parliament election. Number one party forming a government on its own or maybe with coalition. If there is a stable government, the markets will like it, the markets will do well. At least the markets will not correct. On the other hand, if there is any hung parliament, nobody seems to be able to form the government. There is a confusion. Then markets are likely to crash. And I tell you, if any such crash happens, that is the best time to invest. 2016 parliament election, nobody expected Trump will win. 1% of the people who said Trump will win, they also said the market will crash. And in fact, Trump won. In fact, market crashed. But the people who bought in that crash, they made fantastic profit. So now the point here is that, if you are a new investor, willing to invest the money, surely market at all-time high is not the time to invest. And market all-time high is not the problem. You still can invest, but the problem here is the parliament election. Uncertainty. So you remember, as a trader and as an investor, we have to accept that uncertainty is an uncertainty. Okay. So wait for June 4. Let the parliament election results come. So let there be a clarity whether there is going to be a stable government or unstable government or, hung parliament, and then take the call to invest or not. So definitely, if you are a new investor, not a time to invest. Now, second question, what about SIP? If you have already been doing SIP, now it makes sense to continue your SIP. But if you have not been doing the SIP, you want to start your fresh SIP now, But then again, the same thing, I will tell you this is not the right time. Maybe you can wait, you can start your SIP after the parliament election results. Now, when I say this, some people say, I think Mr. Sundar looks, bearish about the parliament election results. So he is worried if market crashes. Sir, I'm not looking to invest new money. I'm not looking to start my SIP, but I've already invested. Now the market is at all-time high. Now what should I do? Should I book the profit? Should I exit my portfolio? Or should I continue to hold? And then my answer is continue to hold. Then the next question comes. Sir, if there is a hung parliament, if market crashes by 10%, 20%, okay, fine. Hoping that market will crash 10%, 20%, you exit your portfolio. What will happen if the market shoots up by 5% or 10%? Both possibilities are there. But I can tell you one thing, the downside, probability is less on the downside, but if that happens, the magnitude of fall can be big. But the possibility of, stable government formation is very, very high. Probability of a stable government formation is very, very high. But if the market goes higher, the magnitude of higher side movement is not very high. Within 1 week, 10 days, Nifty may go up by 1% or 2% or 3%. But in case of hung parliament, it can fall 10%, 15%, 20%. Okay, so that we will leave it. But we don't know. So therefore, what is the best strategy for the people who are already holding the portfolio? So if you are already holding the portfolio, the best strategy is to do the hedging. So what is hedging? Hedging means, if something goes wrong, to your portfolio, you should be able to compensate that loss through some other means. Say, for example, I'll give you the best hedging, what a common man do. If a person is working and is the sole breadwinner in the family, if something happens to him, the family will be in trouble. So, to safeguard his family's interest, what he does? Simple. Take an insurance. So, if something happens to him, the insurance company will pay a good amount of money to the family. So, that is the hedging. But in the hedging, you always lose the money because you have to pay the premium to the insurance company. So that will be the loss. If nothing happens to you, if you live forever, then that insurance money, the premium that you paid is wasted. So same thing here. If you have a portfolio and if you are worried that the markets may crash, what you can do, you can go and buy some put options. Of course, you have to pay the premium. Just like why LIC will have to give insurance money to you if something happens to you? Because they get the benefit of the premium. You pay some premium. So the same way here, if market crashes, somebody will compensate you. Why should they compensate you? Free of cost. No. You have to pay some premium. So that is the put premium. And this most of the people know. But in this video, I'm going to do two things for you. Two very interesting things. One, how to reduce this premium. And number two, how to finance this. In a way, stock market is something very, very interesting field where, you can do the hedge without paying anything from your pocket. Of course, definitely there will be some catch. I will let you know. Now, if you look here, you look at my screen, okay, this is the NSEindia.com option chain, okay. If you look at the option chain, So I'll choose the May month end. Now the market is around 22,600. So let us say 22,500. So you are worried that the market may fall below 22,500. So what people do, they buy 22,500 put option. You can see the 22,500 put option is trading around 250 rupees. But this will give protection only for 1 month. Okay. So assume that you are paying about 250 to 300 rupees, put option money, okay, just for protection of 1 month. So if you want to protect your portfolio for a period of 1 year, you will end up paying about 2,500 to 3,000 rupees. That's too high. Now the lot size is 25. Okay, 25 into 22,000 Nifty if you take it. So it's somewhere around 5.5 lakh rupees is the total contract size. So if you have a portfolio worth about 5.5 lakh rupees, so you have to buy one put option for hedging. But for one put option for 12 months, if you buy, you end up paying about 2,500 to 3,000 rupees. So that will translate into 75,000 rupees. How can you spend so much money for protection? Your portfolio is 5.5 lakh, and how can you spend 70,000 rupees for hedging? That we know like around 15%. Your portfolio is not likely to give such a good profit. How can you spend 15% for the purpose of hedging? Right. So that is why there is one way of hedging. Instead of hedging every month, what you can do, you can go to the month of December. Okay, you can do the hedging. So now it is already April month is over, 4 months are over. Now we have only 8 more months. But again, 22,500 is not trading in December. I'll give you one example. Okay, assume that you have got instead of 5.5 lakh, assume that you have a portfolio of 11 lakh rupees. So that means you have to buy 2 lots of put option. For every 5.5 lakh rupees, 1 lot. For for 11 lakh portfolio, you have to buy 2 lots. So while buying the 2 lots, you buy 1 lot at 22,000, then second lot you buy at 23,000. So that means it will be equal to buying 2 put options at 22,500. This is a concept of averaging. Right? So these are all the interesting things that we discuss in our workshop. So you buy 1 put option at 22,000, 1 put option at 23,000. That means it is equivalent to buying 2 put options at 22,500. Okay, right. Now for the sake of argument, we just take it 1 lot. Okay, although 22,500 is not trading, if it is trading, then that price will be somewhere in between these two. Okay, so somewhere around 420 and 690. So that means that's somewhere around like 500, 550 rupees. Let us say 550 rupees. Okay, so 550 rupees means 550 into 25 is how much? It's about like 12,000, 12,500. So for a capital of 5.5 lakh rupees, at 12,000 rupees, that translates into about how many percentage? Not very big, right? So it's about 2.5%. Okay, so 2.5% premium you are paying to protect your portfolio for 8 months, right? So that makes sense. So in case market crash 5-10%, you are completely protected. No matter how much market falls, how much loss you are having a portfolio, so that much profit will be accruing from this put option. But the point here is that you are almost paying about 500, 550 rupees from your pocket for hedging this. Right. But still, on a portfolio value, so this looks, 2.5% only. So when a very big events like a parliament election happens, you don't mind losing 2.5%. Okay. In case market crashes, you are fully protected. But assume that, you don't want to pay this 2.5%. So there is another way. So what one can do, you can go and sell a call option which is trading around 400, right? So 25,000 call. So you go and buy 22,500 put option and sell 25,000 call option. For buying a put option, you may spend 500, 550 rupees. For selling a call option, you will receive 400, 420 rupees. So effectively, you will be paying only roughly about 100 to 150 from your pocket. So that will be only about 2,500 rupees to 3,000 rupees. So for a 5,50,000 portfolio, you are spending 2,500, 3,000 rupees. So that means, it's hardly 0.5%. So if tomorrow market crashes, you are fully protected. Tomorrow if market falls 20%, you will get that 20% profit in the put option. But whereas from your pocket, you just only paid only 0.5%. You just paid only 0.5%, you are fully protected on the downside. But there is a catch. What if market shoots up? Market shoots up. If the market goes from 22,500 to 25,000, no issue. The 25,000 call will also go to zero. This 22,500 put option, will also go to zero. So you just wasted only 0.5%, but you made a good profit in the portfolio. But in case if the markets goes beyond 25,000, okay, then there will be a loss in the call option, but whereas there's a profit in the portfolio. So practically speaking, you can do this if you are willing to exit at 25,000. You don't mind, exiting your portfolio when Nifty touches 25,000. So this one, again, you have to wait until the end of December. You cannot come out in between or by the end of December. But assume that you don't want to exit your portfolio, but you do not want to lose money in this call option also. So there are various other strategies that can be applied, so that, you can still come out without any loss in the options, whereas while running the profit full-fledged. But, that is beyond the scope of this video. So we do that in our workshop. Okay. So if you are interested to know those techniques, you can consider attending our workshop. So finally I have come back, so it's a promotional video for my workshop. Now, there are some plus points and minus points, as I told you. Okay. So one minus point is that, one plus point is that if the market falls, you are completely protected. But if market shoots up, so you must be willing to exit at 25,000, or you may have to do some adjustments. Okay, second one, buying a put option, no issue. You pay the money, the premium only you have to pay, so you can buy the put option. But you want to sell a call option, you have to pay margin money. I think right now, if you want to sell one call option, the margin money will work out to be around 40,000 to 50,000 rupees. Now, if you don't have so much money, what you can do? Because this is a portfolio hedging. So what you can do, your portfolio, you can just pledge it with the broker. The broker will give a trading limit. You can use that trading limit to sell a call option. But again, there is a problem. Whatever the margin money you have to pay to the exchange, you have to pay 50% in cash component. Only 50% you can pay through the collateral. But if you are holding a portfolio and you give it, then it becomes all collateral. Either you have to bring down 50% cash component, or there are some brokers, they take the full collateral. They don't ask for this cash component. Probably they'll be charging slightly higher interest rate. So you can go and check with your broker. If you are not able to find a broker, you can always contact our office. We will be able to help you. So, events like a parliament elections are very big events. Anything can happen after the election. So it is better, if you have not invested, don't invest, wait, let the parliament election be over. If you have already invested, please make sure that you do the hedging. You don't mind losing 2-3%, you do the simple hedging, just buy a put option. But you don't want to pay so much money for hedging. What you can do, you can buy the put option for hedging. You can finance that money by selling a call option. But anything you do it in December. That's because, put option premium also you will be paying less, but call option premium receiving will also be very high. But the same thing if you look at the monthly option, okay, put option, at the money put option you want to sell, you have to pay 234 rupees. You pay very high, and then you want to sell a 25,000 call option, okay, you only get 5-6 rupees. 24,500 is one trading, but you only get 5-6 rupees. You don't get 450 rupees. Okay, so it makes sense to do the hedging, okay, using the December options. So December options are very good for the hedging purpose. Okay, so I hope you enjoyed watching this video.